Hello everyone. My name is Anjani Kumar Khetan. I am based out of Bangalore. And in this video, we will continue our discussion in the prior video with respect to the net zero commitments. In the previous video, I gave you a theoretical perspective of how the standard setters are looking at the requirement, if at all an entity is required to make provision if it is making net zero commitment. So in this particular video, we will look at a practical case study so that the concept what we theoretically saw in the previous video gets cemented in our mind. So what I will do, first I'll just do a quick recap of what we discussed in the prior video, and then we'll look at the case study. So this will be a familiar flowchart that we saw in the prior video. And this, we said that the provisioning with respect to those net zero commitment or climate related commitments, as per the standard setters, need to pass two separate tests. Okay, and these tests are very, very consistent with what is the normal requirement for making provision under the related provisioning standard, which is IAS 37 under the IFRS world and the Ind AS 37, which is under Ind AS world, right? So this is the crux of what we discussed. So as part of the two-step process, the first step is that the entity need to first determine that because of the net zero commitment or the announcement or the thought process which the entity has, which have been announced, whether that creates a constructive obligation on the part of the entity. Because as we have seen earlier, that under Ind AS 37 or IAS 37, which deals with provisioning, there has to be a present obligation, and that present obligation can be either a legal obligation or a constructive obligation. Now in this case, an entity need to first determine whether, let me clear this, that whether in the two-step process, first, whether the entity has made a specific public statement related to the commitments on climate related requirements or let's say on net zero commitment. If the answer to this question is no, of course, then there is no question of any liability or contingent liability to be reported under the financial statement. But if the answer to this particular question is yes, there is a specific statement which the entity has made, then the next logical question is, okay, you have made the statement, whether that statement which you have made in public, whether that statement creates a valid expectation in the eyes of the public or anyone who is affected by it, that, and if the answer to that question is no, that despite you have made the public statement, it really doesn't create any expectations in the minds of the people affected by it, then of course the same conclusion is driven, which is no liability or contingent liability need to be reported. But if the answer to both these questions is yes and yes, then yes, in that case there is a constructive liability or the constructive obligation which exists for the entity. Now, having determined in step one that the constructive obligation exists because answer to both these questions is yes and yes, then as part of test 2, one got to see whether the measurement requirements of the provisioning standards, which is Ind AS 37 or IAS 37, whether those are met, right? So in step 2, you have to ask questions which are listed at the bottom of the slide that, okay, this public statement which has been made, whether that public statement, does it relate to a past damage done or it is for a future event? Now, of course, if the statement relates to future events, obviously there is no present obligation. Because if you recollect, the basic requirement under IAS 37 or Ind AS 37 is if an entity has the ability to get out of the obligation because of future actions it takes. So, for example, the entity may close the business. If that business is creating, some kind of a environmental issue, they may close the business and avoid the obligation. So if something is relating to future, then in that case, again, there is no liability which is present. But if the public statement relates to an event which has already happened, is a past event. So if the obligating event happens to be a past event, then obviously there is a present obligation. So for example, let us say if entity has actually done some kind of a land contamination in the past. So if that has happened, it is a past issue which the entity wants to make good now. Then in that case, it will be reckoned that yes, the entity has present obligation. And if it is, then you got to ask, okay, that obligation do exist, but whether that obligation will entail outflow of resources, which is probable to happen. Probable is defined under Ind AS 37 or your IAS 37 as something which has the probability threshold of more than 50%, which is more likely than not. Right? So the second question as part of test 2 is whether outflow of economic resources are probable. If they do, then in that case, you got to ask another question. But if they do not, if there is no probability of outflow of resources which is expected, even if there is a present obligation, then only the obligation on the part of the entity is to disclose contingent liability, not to create provision. But if the answer to this question is yes, then the last question one need to answer is what would be the amount involved? Can the amount which would be involved for meeting this obligation, can it be measured reliably? Now, the standard generally believes that it will be very rare that if these two conditions do exist, it will be very rare that the amount can't be measured reliably. So generally, the amount will be able to be measured reliably. But if for some reason, in rare eventuality, if the amount cannot be measured reliably, then again, the entity will just disclose the liability under contingent liability. So which means these three are cumulative and cumulative conditions. Unless all the three conditions are met, IAS 37 or Ind AS 37 does not allow you to make provision. So the same principle continues here as well. And then if the answer to the third question, this question is also yes, then yes, the entity need to provide for the provision. It may need to make provision. So this is exactly what is being mentioned here. So if you look at this chart, this is step 1 will tell you whether the constructive obligation do exist on account of the public statement which the entity has made, on account of these climate commitments or net zero commitment. If answer to this question is yes, and answer to this question is also yes, then in that case, the entity need to make adequate provision for the same. And this is exactly what we will look at. We'll apply these table and this flow chart to see how in a practical world we need to deal with this situation. So let us see a case study which deals with this particular scenario, and we will be using this flow chart as we go along, as we determine and get to our answer. So let's say an illustrative case study. It is similar to what I indicated in the first part of this particular video. Let us consider it is similar to that, but let's see here what the fact pattern is. Now, let us consider a scenario where, let's say in year 2021, a manufacturing entity makes a public statement, but this statement is made in its sustainability report. Okay, so in its sustainability report, it makes a public statement on account of these two things. It says in the report that I will reduce my greenhouse gas emissions by at least 70% by year 2030. We are in 2021. So in next 9 years, the entity intends to reduce the greenhouse gas emission by at least 70%. And this assertion is made in the sustainability report issued by the entity. Also, the entity says that beyond this period, also the entity wants to offset beyond 2030. if any remaining emission is there, the entity wants to offset any remaining omission and thereafter by utilizing carbon credits, which means they will purchase the carbon credits and nullify it if the threshold is not met, so that they are net, zero committed. So for this is the assertion made in the sustainability report. Now it says, to support this announcement, the entity publishes the plan of actions, and that too is given in the sustainability report itself. And as we will see on the slide, there are, let us say, 3 separate pieces to the announcement which has been done, which means to implement this generic thought process, the entity may commit itself to 3 different kinds of activities. Here is the first one. So the first activity to get to this 70% reduction in the greenhouse gas emission, the first assertion or the first step which the entity need to take is these 4 aspects. They want to invest in more energy efficient technology. They will make gradual modification of the manufacturing process or manufacturing, the way the methods are being used in the manufacturing, so that the entity uses energy efficient processes, right? And then rather than purchasing energy, from the traditional sources, the entity, as per the sustainability report, wants to purchase energy, let us say, from renewable resources, wind power or solar power. And they also intend to replace existing petroleum-based inputs. The inputs which is being used in the production process, they want to replace with better alternatives which have low carbon emissions. So this is first set of assertion which is being made in the sustainability report. And this assertion relate to the period 2021 through 2023, and all of these steps taken together is eventually expected to get 70% reduction in the emission. Okay. What is the second assertion? Second assertion, see on the right hand side. What the entity says is that go forward, starting 2030, after this piece is achieved, starting 2030, the entity seeks to purchase and surrender more carbon credits from year 2030 onwards to cancel any remaining emission. So if you have any remaining carbon emissions in this period, for that, they will be purchasing from the market the carbon credits and will be cancelling. And the management believes, if you see at the bottom, management believes that it is confident that despite incurring these expenses, despite making all of these changes and modification to the production process, it will continue to remain profitable in the business. Okay, these are the 2 assertions which have been made. Now, what is the third one? Let us see here. Apart from these, these assertions were made in 2021. Now, there is another piece of information given to you here from 2017-18 onwards, which means a couple of years prior to when these assertions were made. From 2017-18, entity is making, let us say, certified carbon neutral statement on an annual basis. That means every year the statement is being issued by the entity on its carbon neutrality, and therefore to become carbon neutral, the entity in this period prior to 2021 is already tracking and reducing its emission where possible. Plus, any remaining emission is cancelled by carbon credit offset. Now, you can see the difference. In this period also they are following these process. Now, go forward, they want to go more, and get to a much larger emission. 70% reduction, and anything which by going through all of these changes. Now, going forward, if anything is still left over, they want to use the carbon credits. Now, the question is, in this scenario, there are 3 broad questions which we are trying to address. That given that the entity has made assertions here in the sustainability report, first question is whether the entity's commitment which they have made here, does it create a constructive obligation? And if it does, should the provision be required for these two? Because as you can see here, clearly these two are something which the entity intends to take the steps in future beyond 2021. So from 2021 to 2030 and then beyond. Whereas this is something which is in the prior periods, 2017-18, right? So the question is, for these two assertions, do you need to make provision? Okay. And the third bit is, should the provision be required for the bit? Because if you see here, it says, as of 31st of June 2024, in between somewhere, the entity is net negative and is generally expects to remain net negative, which means it will still have the requirement to buy the carbon credits because it is not sufficient enough. So the current processes still leave some emissions for which the carbon credits need to be purchased. Now, with this scenario, how do you deal with how you get to the answer to each one of them? We will use the same principle which we saw in the earlier flow chart, and we'll get an answer to this. So first thing, as we saw, as part of step 1, okay, we determined whether the constructive obligation exists or not. And this is exactly what the first question here is. The first question asks is us to identify whether the entity's commitment creates an obligation for constructive obligation or not. This is exactly what we will look at, and the answer will come from step 1 of our table. So we have seen that. These two questions we have seen that to get to an answer whether constructive obligation exists or not, you got to ask this, that whether the public statement is made regarding the climate related commitments, net zero commitment, yes, in this case. And then whether the public statement has created valid expectations in the eyes of the laws of those who are affected by that. And we have also seen in the prior video, immediately part 1 of the video, we have seen that when this question is to be evaluated, one got to look at what is the nature of a statement which has been made by the entity. What is the method of communication? Now, in our example, there is a formal statement, public statement has been made through the sustainability reporting. In the sustainability report, these statements and assertions are made. Communication, let's say, is made through formal channels and not in social media, right? In those cases, it is fair to assume that the constructive obligation does exist. So in this case, the fact pattern which we have, you can see the commitment was done in the sustainability report. There is a formal approved plan. You have a clear vision in terms of how you want to go about it. There is the existence of a detailed plan and timelines by when, what you want to achieve. This is a long-term plan from 2021 onwards through 2030 and even beyond as well. And because they are issuing the certified statements every year, there is a progress updates are also available. Of course, not related to the ones which is from 21 to 2030, but historically they have been doing it. Okay, so therefore, with given these fact pattern in this particular case study, it will be fair to assume that yes, constructive obligation does exist in the way the entity has made the commitment. So question number 1 of the case study, whether the constructive obligation exists, of course it is judgmental, but it will be fair given the information in this particular case study, it will be fair to assume and conclude that yes, constructive obligation does exist. Now, once this is done, this is not sufficient. You have to also go to step 2 to see whether the requirements of step 2 is met. Unless and until 1 and 2 is collectively met, no provisioning is required. So therefore, now let us see whether requirements of step 2 is met in this particular case. See here, we have already seen this flow chart a couple of times. So 3 things which you got to ask: whether this obligation relates to past damage, outflow of economic resources is probable, and amount can be determined reasonably or reliably. So if all these 3 conditions are yes, then only provision can be made. So in this fact pattern which we have, the question number 2 was that in the in the case study, the entity wanted that it will invest in more energy efficient technology, gradual modification. All of these steps which the entity intends to take from 21 to 2030, they are all future operating expenses, because future investment will be done in these, future modification in the processes will be done, future acquisition of resources like your renewable resources, or for that matter your inputs. Future, all of these are future operating expenses, and therefore you fall into this bucket and not meeting the criteria of the existence of the present obligation. So since it is not there for this particular question, wherein should an entity make a provision for this, even if constructive obligation does exist, because the second step of the criteria is not met, in this case, the standard setters have given a guidance that in these cases, for these expenses, you are not required to make provision. What about the second condition? What about the second question? The entity needs to purchase beyond 2030. They want to purchase and surrender carbon credits for any possible shortfall. Now this, just like the previous case, this is also future operating expenses, because all of those things which will happen beyond 2030 is being talked about here. So the future emission reduction, emission in 2030 and beyond, all of these is something which is a future, relates to future event, which technically speaking, the entity may avoid by exiting from the business itself. And therefore, this liability arising in question number 2 is from year 2030 onwards, not prior to that. And therefore, no provisioning will be required until 2030. Once the actual emissions and all start here, if there is a shortfall here which requires them to buy carbon credits, that is the point in time a possible provisioning can be made. So, like the first question, even in the second question, this question, answer is the same. That is, it's a future cost related. These are the costs related to the future, and therefore, no liability or contingent liability need to be recognized for these two types of cost. As we have seen in the first video, I have mentioned very categorically that each individual activity as part of the commitment which the entity has made need to be evaluated separately to make a provision or not. Now in this case, in the case study we had 3 such pieces. The first piece is this, second piece is this, and the third one was prior to the 2021, and where we had a question whether in 2024 reporting period do you need to make provision, which is related to prior periods. So let us see that piece also in the next slide. So first two questions, no provision, no liability, no contingent liability. What about the third one? So the question which we are trying to answer, whether the answer will change for question number 3, let us see this. Now, what was question number 3 is this. So I brought forward, this was the question number 3. So given the information in the case study, let us evaluate whether the entity's commitment to become carbon neutral requires provision to be created under IAS 37 or Ind AS 37 for this piece. Because from 2017 onwards, there is a certification, annual certification, which is being done by the entity. Now, when it comes to 2024 reporting period, the entity is net negative, which means it has an obligation related to this period. And it expects that it will remain net negative also on the reporting period. Okay. Therefore, in this case, obviously the obligation does exist. Why the obligation does exist? Because the entity, if you see on the right hand side, why the obligation exists? Because the entity is committing to the carbon neutrality and is making the annual certified statements. In fact, it is actually being carbon neutral since 2017-18 by way of buying any shortfall. So commitment is made in sustainability report every year. There is a formal approved plan which exists, annual certification process is in place, remaining omission, if any, are cancelled, and certified statements are made every year. Now, with these, obviously, the constructive obligation does exist. Now, for this kind of a for this question number 3. But the question is whether step 2 is also satisfied. Now, in this case, this particular requirement is for a prior period. Carbon neutral statement in this case relates to 30th June 2024 reporting period as of that period when the entity is reporting. So it is not relating to future period. It is the period for which it is presenting its financial statements, right? So carbon neutrality statement relates to the period which is being reported, and therefore, will outflow of resources be probable? Yes, because if the entity is net negative, it will need to buy more carbon credits from the market, and therefore net negative carbon credits will be bought and will cancel the remaining obligation. So, will outflow of resources be probable? Of course, to the extent of the shortfall. When the entity is buying the carbon credits, it will entail outflow of resources you'll have to pay. And whether the amount can be measured reliably, of course, because carbon credits have its own value. So if suppose each carbon credit, as an example, cost 10 rupee, then in that case, whatever the shortfall number of quantity, let us say X into 10 is the amount which you can reliably measure. So if that happens, in that case, in this fact pattern, for this question number 3, provision is required, unlike the previous 2 questions which relate to expenses to be incurred in future period. There we said provisioning is not required. Why? Because even if constructive obligation do exist in both the cases, the step 2 on the recognition of the criteria under IAS 37 or Ind AS 37, that is not met. Right? That's how one should look at it, the guidance coming from the standard sectors. So this is exactly what I wanted to cover in this particular video. I just hope that all these videos which I've been regularly sharing with all of you over the last few weeks is something which is helpful for your professional work. If you are liking it, I will really urge all of you to subscribe to my channel and then make comments in terms of what exactly your thought process is, whether you are liking or if anything needs to be done. All of those comments will be very helpful for me as an individual as well as for the channel. Please support the channel so that I continue to put in my efforts to make sure that I come out with these kind of a professional videos which is for the benefit of the entire professional community. Please do share these videos with anyone whom you know of, also who may be in need for this kind of information. Thank you for your attention, and I will see you in the next video very soon with another topic which is of pressing or relevance. Okay, thank you very much. Bye for now.